You sit before the screen, watching the market pulse with every tick. Green, red, green, red. The rhythm mimics your own heartbeat, steady until it isn't. The trade moves against you. A small loss grows. Your finger hovers over the exit button. The discipline you promised yourself this morning begins to crack under the weight of emotion. Just a little longer, whispers that voice inside you. The same voice that has eroded countless accounts before yours. What separates the consistent trader from the one who eventually fails? It isn't intelligence. It isn't market knowledge. It isn't even your strategy. It's your relationship with loss. The 2% rule, perhaps the most misunderstood principle in trading, isn't merely about mathematics. It's about psychology. While most believe it's simply about limiting your position size, the truth runs deeper, touching the core of how wealth actually compounds over time. I've watched traders with brilliant systems destroy themselves by misapplying this fundamental rule. They focus on the money, the immediate pain of taking a loss, rather than understanding the profound mechanics of what truly builds a millionaire mindset. The market doesn't reward those who cannot face reality. It punishes hesitation born of fear. It exploits indecision fueled by greed. What if I told you that the original 2% rule, when properly understood, isn't about limitation at all? What if this rule, properly applied, is actually the gateway to freedom in your trading? The difference between the trader who builds lasting wealth and the one who eventually fails isn't found in their winning percentage. It's found in how they protect their capital during the inevitable moments when they're wrong. Today we unravel the truth about stop losses that the majority have backward. The common interpretation of the 2% rule is shallow. Most traders believe it simply means never risk more than 2% of your account on a single trade. They focus entirely on the dollar amount, calculating their position size meticulously, believing this mathematical formula alone will protect them. But numbers don't execute trades. Humans do, and humans are emotional creatures, particularly when money is involved. Consider what happens in the mind during a losing trade. The market moves against you. Your carefully calculated 2% risk is now being tested. What unfolds next reveals everything about your future as a trader. The amateur sees the loss growing and panic rises. They abandon their plan. They move their stop loss, hoping for a reversal. They average down, compounding their risk beyond that initial 2%. They've broken their own rules at the first test of their resolve. This is why most trading accounts eventually collapse, not from a strategy failure, but from a mindset failure. The trader lacks the emotional fortitude to honor their own predetermined risk parameters. The 2% rule isn't merely about the mathematics of risk. It's about training yourself to accept loss as part of the process. It's about cultivating the discipline to execute your plan exactly as designed, regardless of how your emotions fluctuate during market hours. The true millionaire trader understands something profound. Consistency isn't about winning. It's about surviving long enough for your edge to manifest through the law of large numbers. It's about protecting your capital so thoroughly that you're still standing when others have been wiped out. Think about the casino. The house edge might be small, perhaps only 1–2% on certain games. Yet the casino always wins over time because it has the capital to weather the inevitable losing streaks. The casino operates with perfect patience and perfect consistency. It never deviates from its mathematical edge, regardless of short-term outcomes. Your trading account must operate with this same mechanical precision. But unlike the casino, you have fear and greed working against your best interests. These emotions are not character flaws. They're evolutionary responses wired into your brain, designed to keep you alive in a world very different from financial markets. The paradox of successful trading is that the very emotions that helped our ancestors survive in the wilderness now sabotage our ability to navigate markets effectively. Markets don't reward our natural instincts, they punish them. When a trade moves against you, your brain processes this as danger. It triggers the same fight or flight response as a physical threat. Your rational thinking becomes compromised. Your time horizon shrinks to the immediate present. You make decisions to alleviate emotional pain rather than to optimize long-term results. This is where most traders misapply the 2% rule. They set the parameters correctly but lack the psychological strength to honor them when under pressure. They don't understand that the true purpose of the rule isn't merely mathematical, it's to establish a framework where losses are small enough to be executed without emotional resistance. The original wisdom behind the 2% rule wasn't just about limiting financial damage, it was about limiting psychological damage, creating an environment where following your system becomes psychologically easier than breaking it. The path to trading mastery begins when you realize that your greatest edge isn't your strategy. It's your capacity to execute that strategy with unwavering confidence, regardless of short-term outcomes. Let me reveal what the original 2% rule truly means, what the market veterans who created it actually intended. It's not simply about risking 2% of your capital on a single trade. It's about engineering an environment where your psychology can operate optimally over the long term. The 2% threshold wasn't chosen arbitrarily. It emerged from decades of observation about human behavior under financial stress. When losses exceed approximately 2% of total capital, the average trader's decision-making begins to deteriorate. Emotions overtake logic, system adherence weakens. The primitive brain, concerned only with immediate survival, overrides the rational mind that understands compound growth. This is the inflection point where most trading careers begin their slow collapse. Not from a single catastrophic loss, but from the gradual erosion of discipline that follows emotional destabilization. Consider the mathematics of recovery. A 10% account drawdown requires an 1% gain to break even. A 20% drawdown requires a 25% gain. A 50% drawdown, which countless traders experience through position sizing errors, requires a 100% gain, just to return to your starting point. The mathematical reality of compounding works ruthlessly against the They obsess over win rates, entry techniques, and technical indicators, allocating perhaps 90% of their learning to finding winning trades. Meanwhile, they neglect the true determinant of longevity, how they respond when they're wrong. I've mentored traders who win on 70% of their trades yet still lose money over time. I've also guided traders with 40% win rates who consistently grow their accounts. The difference isn't in how often they're right, it's in how they manage being wrong. The millionaire trader embraces a profound truth. The goal isn't to avoid losses. The goal is to make losses irrelevant through position sizing and emotional management. Think about this carefully. What if you could remove the sting from losing trades entirely? What if a loss carried no more emotional weight than paying a small toll on a highway? This emotional neutrality is the true superpower of elite traders. When you risk precisely 2%, not 5%, not 10%, something remarkable happens. The loss becomes psychologically manageable. Your decision-making remains unclouded by fear. Your adherence to system rules stays intact. This creates the foundation for something far more powerful than any technical strategy: consistency. Now let me expose 3 critical misconceptions about the 2% rule that keep most traders trapped in mediocrity. First, many believe the rule means you should lose 2% of your account when you're wrong. This is backward. The rule means your stop loss should be placed at a technically valid level based on market structure. Then your position size calculated to limit risk to 2% if that stop is hit. The difference is crucial. One approach lets emotions dictate your exit, the other lets market reality dictate it. When you place stops based on market structure, support, resistance, volatility measurement, rather than an arbitrary dollar amount you're willing to lose, you align yourself with market reality. The market doesn't care about your personal risk threshold. It moves according to its own logic. Your stops must respect this reality. Second, traders misinterpret the rule by applying it inconsistently. They follow it when it's convenient and abandon it when tempted by exceptional opportunities. This selective application destroys the psychological framework the rule is designed to create. The power of the 2% rule emerges not from occasional use but from its application as an inviolable law, a line never crossed regardless of circumstance. Remember, every significant market blow-up in history began with the words, "This time is different." The moment you make an exception to your risk parameters is the moment you abandon the mindset that produces long-term success. Third, and perhaps most destructive, traders fail to understand that the 2% rule applies to concurrent risk, not just individual trades. If you have 5 positions open, each risking 2% of your capital, your actual portfolio risk is 10%. The correlation between two stocks in the same sector risking 2% each might effectively create 3-4% total risk due to their tendency to move together. The sophisticated application of the 2% rule accounts for these correlations. It views risk holistically across the entire portfolio. This is why professional trading operations use complex risk management systems that calculate not just position size but correlation factors, volatility adjustments, and market condition modifiers. But even without such sophisticated tools, you can apply this wisdom by simply reducing position size when taking multiple correlated trades. If your standard risk is 2% per trade, perhaps lower it to 1.5% when adding positions in related instruments or similar setups. Now let's address perhaps the most misunderstood aspect of all: psychological stop losses versus executed stop losses. Many traders set their stops but fail to actually execute them. They watch the price hit their predetermined exit point, then hesitate. They tell themselves stories. It's just a slight overshoot. It will bounce back. I can't afford to take this loss. This precise moment of hesitation, is where trading accounts begin to die. Elite traders understand something the average person doesn't. The decision to exit is made before the trade is entered, not as a general intention but as an absolute commitment. The stop loss isn't merely a suggestion, it's as binding as a legal contract with yourself. When you enter a trade, you are simultaneously making two decisions: where you'll enter and where you'll exit if wrong. Both decisions carry equal weight. Both require equal commitment. The entry is a hypothesis. The stop loss is your acknowledgement that hypotheses are often incorrect. This level of pre-commitment requires a rare form of intellectual honesty. You must acknowledge your fallibility in advance. You must accept that your brilliant analysis, your compelling chart pattern, your carefully researched thesis, any of these can be rendered wrong by the market's verdict. This radical acceptance of potential failure before it happens is what separates the amateur from the professional. Amateurs enter trades hoping to be right. Professionals enter trades accepting they might be wrong. This subtle difference in mindset creates an entirely different relationship with the market. Now consider what happens when you honor your stops with religious discipline. Your mind begins to trust your system. Your emotional volatility diminishes. Where once you felt fear or greed, you now feel a steady calm, the calm that comes from knowing you're adhering to a framework designed for long-term survival. This consistency creates a positive feedback loop. As your emotions stabilize, your decision-making improves. As your decision-making improves, your results gradually enhance. As your results enhance, your confidence grows. Not the fragile confidence of someone who hasn't been tested, but the earned confidence of someone who has faced losses and survived them. The 2% rule, properly applied, doesn't just protect your capital, it protects your greatest asset as a trader, your mental equilibrium. It creates an environment where you can sustain the patience required for compounding to work its magic. Consider a trader who risks 2% per trade and wins on 50% of trades with a 1-2 risk-reward ratio. With perfect execution, this trader will grow their account by roughly 50% annually. Now consider a trader with the same win rate and risk-reward who occasionally breaks their rules, holding losses beyond stops, taking oversized positions on sure things, failing to take profits according to plan. This trader might actually lose money despite having the same fundamental edge. The difference isn't strategy, it's execution. And execution is determined not by market knowledge but by psychological stability. This is the profound insight that most trading education completely misses. They sell you entries, they sell you setups, they sell you indicators, but they fail to address the core determinant of success: your capacity to execute with machine-like discipline in the face of uncertainty. The elite trader doesn't have better information than you. They have better emotional regulation. They've trained themselves to execute their system regardless of how they feel in the moment. They've developed the capacity to act against their instinctive emotional responses when necessary. This is what the original architects of the 2% rule understood. They weren't just protecting account balances, they were protecting minds from the destructive power of oversized losses. They were creating psychological safety zones where traders could operate rationally rather than reactively. When you limit risk to 2% per trade, you're saying, "This loss cannot hurt me enough to change my behavior." You're building a fortress around your decision-making process, protecting it from the siege of emotions that large losses inevitably trigger. This is the original wisdom of the 2% rule. Not merely risk management, but mind management. The journey to trading mastery isn't found in discovering some secret indicator or entry technique. It's found in the quiet discipline of managing yourself first, and the market second. I remember the day this truth finally settled into my bones. I had been trading for years, constantly searching for the perfect system. I had studied price action, volume analysis, market profile, Fibonacci, every methodology promising the path to consistent profits, yet my results remained frustratingly inconsistent. Then one morning, sitting before my screens as the market opened, I realized something that changed everything. The variable in my trading wasn't my strategy. My emotions on Monday were different from my emotions on Friday. My psychology after 3 winning trades was different from my psychology after 3 losers. I was the inconsistent element in my own equation. That day I stopped looking outward for answers and began looking inward. I committed to the 2% rule not as a mathematical formula but as a psychological framework. I vowed that no single loss would ever impact me emotionally again. I would make each loss so small, so insignificant, that my mind would barely register it. Over the months that followed, something remarkable happened. As the emotional impact of losses diminished, my decision-making cleared. Without fear clouding my judgment, I could see opportunities more objectively. Without the pressure to recover losses, I could maintain patience for ideal setups. Without greed pushing me toward oversized positions, I could maintain rock-solid risk parameters. My equity curve, once resembling a chaotic mountain range, began to smooth. The violent swings moderated. The account began to grow, not dramatically but steadily. The power of compounding began to work for me rather than against me. This is the path available to you right now, not through some revolutionary strategy, but through revolutionary self-management. The market rewards not the trader who wins the most, but the trader who survives the longest with their edge intact. Think of trading like walking across a desert. The amateur carries as little water as possible, moving fast, taking risks, hoping to reach the other side quickly. When unexpected difficulties arise, as they always do, they find themselves without reserves, vulnerable to the elements. The professional carries more water than seems necessary, moves at a sustainable pace, and reaches the other side not first but reliably. Your capital is your water in the desert of the markets. The 2% rule ensures you never risk dying of thirst, never risk the catastrophic loss that ends your journey permanently. It guarantees you'll survive long enough for your edge to manifest, for compounding to work its magic. The millionaire traders I've known share this quality. They're not necessarily the most brilliant analysts or the most skilled technicians. They're the most consistent executors. They treat their trading rules with religious reverence. They respect the psychology of the endeavor more than the mechanics. They understand that steady compounding of modest gains, protected by disciplined risk management, eventually creates extraordinary results. The question before you isn't whether you can find winning trades. The question is whether you can manage yourself so thoroughly that the inevitable losing trades never derail your progress, whether you can make peace with small losses as simply the cost of doing business, whether you can shift your focus from short-term outcomes to long-term process. The 2% rule, properly understood and applied, isn't a limitation, it's liberation. It frees you from the emotional turbulence that destroys most trading careers. It allows you to act from a place of calm confidence rather than reactive emotion. This is the discipline that builds trading fortunes, not in dramatic leaps, but in protected steps that accumulate, compound, and eventually create the exponential growth that turns modest accounts into significant wealth. The path is before you. The choice, as always in trading, remains yours alone.